XRP supply squeeze? What escrow data and ETF hype mean for liquidity, October 9th, 2025. As conversations around potential spot XRP ETFs gather steam, industry observers are revisiting a fundamental question. Does XRP's supply structure, especially the Ripple escrow system, leave the token vulnerable to a genuine shortage if institutional demand arrives at scale? Recent commentary from crypto observer Kenny Nguyen and a string of market signals suggest this is less a speculative soundbite and more a structural debate that could reshape how XRP is used and held. At the heart of the discussion are clear public supply metrics. XRP's maximum supply is hard-capped at 100 billion tokens. Current figures place circulating supply in the mid-60 billions, while roughly one-third of the total, a ballpark of 35.3 billion XRP, remains in escrow. Released on a predictable, time-based schedule, a small number of tokens have been permanently burned, on the order of millions, while active network addresses number in the millions, indicating ongoing usage and wallet activity. These raw numbers matter because they frame the fundamental interplay between how many tokens are available to trade today and how many can be introduced to markets on any given day. Kenny Nguyen's recent social posts emphasize an intuitive scenario. If multiple institutional products, spot ETFs among them, begin to absorb supply, a significant portion of tradable XRP could be effectively removed from short-term circulation. ETFs typically require custodial holdings that sit off-exchange. Large inflows into ETF structures therefore reduce tokens available to traders and market makers, tightening liquidity and increasing the price impact of buys and sells. Nguyen's point is not a prediction of price, but a practical insight. When demand comes from institutions that buy and hold, scarcity is a functional outcome even when token supply itself does not change. That said, the counter-argument is equally practical. The escrow mechanism exists precisely to provide Ripple and the broader ecosystem with a steady, programmatic stream of supply. If Ripple continues to release and distribute meaningful tranches from escrow, and if those tranches are sold or distributed into exchanges and liquidity pools, the market's tradable supply can expand at the same time institutions accumulate. In that case, the sell-side pressure from escrow releases could blunt shortages and dampen upward pressure in short windows. The result would be a market where institutional demand and escrow supply dynamically offset each other, keeping liquidity relatively broad. Which of those two forces dominates is a structural question determined by a few concrete actors and behaviors. First, how custodians and ETF managers accumulate and custody XRP matters. Do they acquire tokens off-exchange via OTC desks that do not immediately affect exchange order books, or do they buy directly on exchanges where order book depth is thinner? Second, how Ripple times and markets its escrow releases, and whether custodial entities coordinate purchases at scale, will influence whether newly released tokens are absorbed by the market or pushed into circulating liquidity. Third, the emergence and adoption of stable, institutional-grade alternatives like RLUSD, Ripple USD, could redirect transactional demand away from XRP. If enterprises prefer RLUSD for payments and settlements because of price stability or regulatory clarity, XRP's role could skew more toward reserve holding asset rather than day-to-day liquidity rail. This nuanced dynamic matters because it shapes market utility. If ETFs absorb a large fraction of supply without proportional new issuance into exchanges, XRP could become harder to source for large transactional flows, increasing slippage for businesses that still rely on XRP for cross-border liquidity. Conversely, if escrow releases keep pace and those tokens re-enter exchange liquidity, enterprise adoption may continue unimpeded, but the price effect of ETF flows could be muted relative to headline expectations. A further wrinkle is the near-term regulatory and administrative calendar. ETF approvals and the practical window for large institutional accumulation are influenced by national regulatory decisions and operational timelines. Any delays, shocks, or windows of accelerated approvals can materially change how custodians execute purchases, potentially creating bursts of demand that interact with escrow schedules in unpredictable ways. Moreover, market activity has recently shown that unlocked escrow tranches can be large and swift. Public chain trackers have recorded large unlocks and movements that temporarily alter the balance of available supply. Another factor worth noting is liquidity sourcing. Large institutional buyers rarely rely solely on exchange order books. Over-the-counter, OTC trading, lending desks, and bespoke custody arrangements are common. These channels can mask much of the underlying demand from public order books, making on-chain supply metrics even more critical for analysts trying to forecast real-world availability. In short, public metrics show what exists and where it is nominally held, but not always how institutions will operationally acquire or steward those holdings. Because of these moving parts, prudent market participants should treat the supply shortage thesis as a conditional scenario. It becomes plausible when 1. Significant ETF-driven demand materializes, 2. Escrow releases remain limited or are absorbed into long-term custody rather than circulating liquidity, and 3. Enterprises continue to value XRP as a settlement asset rather than migrating en masse to stable alternatives. If one or more of those conditions fail to hold, for example, if escrow release velocity increases or RLUSD adoption accelerates, the shortage thesis weakens. What should market participants do with this analysis? First, investors and institutions should track escrow release schedules and on-chain transfer activity closely. These are the clearest public signals of supply-side shifts. Second, traders should be conscious that the arrival of institutional demand can reduce market depth and increase slippage. Risk controls and pre-positioning strategies become essential. Third, enterprises and treasury managers deciding between XRP and stablecoin rails should weigh not only fees and speed, but also the evolving liquidity profile under large-scale institutional uptake. Ultimately, the conversation prompted by Nguyen AS posts is valuable because it reframes a familiar question: will the price go up? Into a structural one: how will supply management, custodial behavior, and alternative rails collectively determine XRP's practical utility and liquidity profile as institutional interest increases? On October 9, 2025, that remains the core issue driving debate in both trading desks and corporate treasury meetings. Disclaimer: this article is informational only and does not constitute financial advice. Readers should perform their own research and consult qualified advisors before making investment or operational decisions.